If you are sitting there thinking that your private pension is the one safe haven left for your family inheritance, I have some devastating news for you. The rules of the game did not just change, the entire board has been flipped over. For years, we were told that pensions were the ultimate tax-efficient way to pass wealth to the next generation. As of the autumn budget 2025, that era is officially over. We are going to go through the 2025 autumn budget at proper Treasury depth. This is not a political rant. This is a financial autopsy written at the same technical level you would see inside the Red Book itself. By the end of this discussion, you will know the 6 measures that will cost the average pensioner thousands, the handful that will actually put money back in your pocket, and precisely what you need to do before the worst changes bite in 2026 and 2027. Let us begin by looking at the headline numbers from the Office for Budget Responsibility. The Chancellor has raised taxes by £40 billion a year, which is the largest tax rise since 1993. Most of that £40 billion is coming from 3 specific places. Number 1 is employers' national insurance. Number 2 is closing what the Treasury calls inheritance tax avoidance routes, which is simply Treasury speak for taxing your pension when you die. And number 3 is a blizzard of smaller changes to dividends, savings, interest, capital gains, and frozen thresholds. The net effect of all this is quite stark. If you live only on the state pension, you are broadly protected and in fact, you are slightly better off. However, if you have a private pension, shares outside an individual savings account, a second home, or a pot you hope to leave to your children, you are facing the most aggressive attack on private retirement wealth in living memory. We are going to look specifically at the 6 measures that will hurt you the most. Number 1 is that pensions have been dragged into inheritance tax. From April 2027, your unspent defined contribution pension and most defined benefit pensions will be included inside your estate for inheritance tax purposes. Anything over roughly £1 million left to non-spouse beneficiaries will be taxed at 40%. The Treasury impact is estimated to be £2 to £3 billion a year by the early 2030s. The impact on you will be 6-figure tax bills that simply did not exist before. This is the single largest structural change to United Kingdom retirement savings since the pension freedoms of 2015, and it is overwhelmingly negative. Number 2 is the dividend tax, which is up 2 percentage points from April 2026. The basic rate dividend tax goes from 8.75% to 10.75%. The higher rate goes from 33.75% to 35.75%. To put this in real terms, if you have £200,000 in a typical global equity portfolio outside an individual savings account yielding 4%, that is £1,600 a year, gone from April 2026, that is real money taken directly out of your monthly grocery budget. Number 3 is the savings interest tax, which is also up 2% from April 2027. The basic rate tax on interest outside the personal savings allowance rises from 20% to 22%. The higher rate rises from 40% to 42%. With cash rates still around 4 to 5%, a £100,000 cash pot outside an individual savings account will lose an extra £400 to £800 a year. Number 4 is the capital gains tax on residential property. If you downsize and your second home or buy-to-let has gone up in value, the tax on the gain jumps from 24% to 28% for higher rate taxpayers. That represents an extra £10,800 in tax on every £100,000 of gain. Number 5 is that income tax and national insurance contribution thresholds are frozen until 2031. The state pension is rising 4.8% next April, but your personal allowance is not. Every single year, more of your state pension plus private pension becomes taxable at 40%. The Institute for Fiscal Studies estimates that 800,000 extra pensioners will be dragged into the higher rate band by 2030. Number 6 concerns agricultural and business property relief, which is now capped at £1 million combined transferable allowance. If you are a farmer or you own a family business, The 100% relief drops to 50% above £1 million. Many family farms valued at £3 to £5 million will now face seven-figure tax bills. Now, let us look at the measures that actually help, because there is some good news. The state pension triple lock is protected, meaning a rise of 4.8% next April. That is £475 to £575 extra, depending on your current amount. Green levies are being removed from electricity bills from April 2026, which is an average saving of £150 per household. The fuel duty 5p cut has been extended another year, putting roughly £89 back in your pocket if you drive. Prescription charges are frozen in England, and rail fares are frozen, which is small but useful. Lastly, the Help to Save scheme has been made permanent, offering a 50% government bonus if you qualify. The net result of all these changes is that if you live only on the state pension and have no investments, you are £600 to £800 a year better off. However, if you have any meaningful private wealth, the losses swamp those gains many times over. The Treasury has decided that investment income should be taxed almost identically to earnings. Whether you agree or disagree with the politics, the financial reality is now set in legislation. So let us see what you should do before the guillotine falls. Here is your Treasury level action plan. Number 1, before the 5th of April 2026, fill your individual savings account and your spouse's individual savings account. That is £20,000 each. If you can, every year, that is £80,000 for a couple over the next 2 years, completely shielded from the dividend and savings interest tax rises. Number 2, review your pension expression of wish form today. Make sure it is up to date because it still controls who gets the money before the inheritance tax rules bite. Number 3, if you have a large unspent pension and want it to go to children or grandchildren tax efficiently, consider accelerated drawdown into an individual savings account or spousal bypass trust while the window is still open. You should speak to a regulated advisor because the deadline is effectively April 2027. Number 4, gift while you can. The annual £3,000 gift exemption and the normal expenditure out of income rule are unchanged for now, so use them. Number 5, if you own shares paying high dividends outside an individual savings account, move them inside before April 2026. The process known as bed and individual savings account is still allowed. Number 6, farmers and family business owners must start succession planning now because the £1 million cap is law from 2026. The 2025 budget has redrawn the retirement landscape. The Treasury has decided that private pensions are no longer a tax-efficient way to pass wealth down the generations. Your job and our job together is to adapt faster than the taxman can legislate. You must look after your money because nobody in government is going to do it for you. Please do not forget to ask any questions you need help with regarding your circumstances. We will see you in the next video.